We just saw the S&P put in the worst stock market performance of the last 6 months. Hey everybody, this is Brant from Wolf on Wall Street Trade and the technicaltake.net. Hopefully you were able to catch my video of February 23rd, because in this video I covered at least 3 signals that were warning that the stock market was in for some serious volatility, and this was around the same time that the S&P 500 was trading at all-time new record highs. We got our ABI signals. I've been working on these for about a decade. They're very rare. They have about a 90% hit rate. I usually use them to trade volatility, but when volatility increases, stocks are usually going down. So let's take a look at the move in VIX. Typically, an ABI signal produces a move of about 50% in the VIX over the next 1 to 30 days. We saw a 68% move on the close in VIX since our first ABI signal, and up to 79% intraday. The last time we got a cluster of these was in July, and we saw the tech wreck sell-off, with VIX trading up over 215% on the close and over 400% intraday. We had some subscribers that were up over $100,000 on long VIX futures. That last set of signals also led to, here are the signals, the S&P declining 13.25% on, the NASDAQ on a closing basis, and over 15% intraday. The tech wreck sell-off, tech has never, ever come back from that as far as leadership goes. We also got the highest skew reading in history on February 18th over here, above 180 skew, as according to the CBOE white paper, is elevated and in red flag territory above 150. This tells us that institutional money was hedging extreme downside risk, black swan tail risk event. I also warned in the video that there were signs of liquidity draining. So here is S&P futures on a 30-minute chart. You can see the dates of February 13th through the 20th, and USD JPY, or the carry trade. Money was flowing out before this sell-off started. Now we're kind of in line here, but this was the red flag warning signal. 3 of them right in a row, all at the same time, as the S&P was at all-time new record highs and retail was chasing prices higher. In that video of February 23rd, I believe it was, I asked the rhetorical question when we were looking at a broadening top: could the S&P come down all the way to the bottom of this broadening top and make a lower low? It was a rhetorical question in my mind. If we look at the S&P 500 now, here we are with prices having come down to make a lower low in this broadening formation, which is a formation of higher highs and lower lows. It is a picture of chaotic environment with no leadership that's reacting to news and rumors. However, we did get the same very target information from watching price action, measured moves. So this was a post, a member's post from February 27th. Second leg down began, and then scrolling down the post a little bit, here was the information. S&P 500, we have a bearish symmetrical triangle with a measured move down to 5,700. It was actually a range, 5,700 to 5,725. If we look at the S&P 500, you can see that we tagged that range at 5,700. So this is price telling us in advance what it's going to do, where it's going to go. Now, the 2 most probable scenarios once a second leg measured move is hit is either we get a big consolidation or we get an oversold rally rebound. The third probability, and the least likely, is that we continue the sell-off. Just to give you the technique, and this is going to be a little rough and tumble, it's not going to be exact, but to get that measured move second leg down, we take our first leg down, and this is going to be a little bit rough because I'm not kind of zooming in all the way to the exact points, but it was, I could tell you it was 3.8%, And if we take that from the break over here, we get at 3.8%. We're right at that 5,700 level, 5,700 to 5,725. We can already see kind of the bear flag forming here. The question is, does this bear flag hold up? One of the couple things that I'm looking at is first the measured move, about 3.6% to roughly 3.9%. We've only hit about half of that at about 1.4%. If you do not get the full measured move, it is likely that you are seeing a failed flag, or if price moves back into this flag or certainly above it, then we are getting information that's telling us that that flag is invalid, nullified, and that we're in a transitional state likely to move into like an oversold rebound rally. The other thing we can look at is quite simply the price trend of lower highs, lower lows, which is a downtrend. I'm not going to draw them all in here for you, but just to give you a sense, lower highs, lower lows, and this is what makes up a downtrend. And conversely, an uptrend is higher highs, higher lows. So every single one of these pivots that you will see is either a lower high or a lower low, and we are still in effect with that. If we make a higher high or a higher low, then we negate that downtrend. Interestingly, the S&P 500, both its measured move and the lower low in the broadening top came right in at the S&P's 200-day moving average, which it held on Friday. Now the NASDAQ 100 closed below its 200-day. It has not closed below its 200-day in 2 years. It has traded below and then recovered back above, but has not traded and closed below in 2 years. So does this necessarily mean that we're going to see a bear market crash and a whole nother big leg down? No. But what it's telling us is that there is a significant change in character. And as I always say, changes in character almost always precede changes in trends. The market will give you hints. A lot of times they're subtle, but if you pay attention to them, they will tell you what is coming, just like the measured move. Now, since we've hit the measured move, the question is, do we move into a larger bearish consolidation and get ready for another leg down? Or are we going to see an oversold rebound rally? I favor the second, but I also favor objective evidence, and we don't have a lot of it yet. It can build very quickly within hours. A lot of the times what I'll see is 3C divergences, and this is 3C versus SPXU, the 3 times leveraged short S&P 500 ETF. A lot of times what I'll see is the fast money traders that are in these leverage products act first before we see it in the averages, the main indices. So if we look at this, we can see them hanging in here, just riding that trend in the S&P 500 down. But as we get towards the measured move, what we can see is 3C negatively diverging. That is profit taking. It's not like all out selling of this, but it's profit taking. We can see the same thing in SQQ, which is the ETF for the NASDAQ 100, 3 times leveraged short. And again, here you see 3C confirming the gain in this ETF, which is leveraged short. So that means the loss in the NASDAQ 100. But over here, we're seeing some profit taking. Now, we're not seeing the same enthusiasm on the leveraged long side. So if we look at like TQQQ, 3C is still pretty much in line to the downside. There's a slight positive divergence in UPRO, which is the 3-time long S&P 500, right over here at Friday's intraday low. But this is not anything to hang our hats on yet. It is just something to pay attention to as we move into next week. One of the more interesting things I've been saying, semiconductors are the canary in tech's coal mine, and the SOX index has a big head and shoulders top. Here it is with the left shoulder, with the head with an elongated right shoulder, and that right shoulder is breaking down and heading towards this neckline. If it hits that and then we get a break of the neckline, we've got almost a 30% measured move down in the SOX index. That's really, really ugly stuff. That will lead the entire market lower. But what I want to address is some support, some short-term or potential short-term support that we're looking at right now in the neighborhood. Here's a 30-minute chart of the SOX index. In that last video that I did just under 2 weeks ago, I said prices were filling the gap, but we were seeing 3C selling right in here, and then the trend breaks. Bear flags, bear flags. If we move in a little bit closer to a 5-minute chart, we see that we're seeing a price test at around 44.70 for the SOX index. If we look at the ETF for semiconductors, SMH, and its 3C chart, we see a lot of 3C confirmation to the downside. Not a whole lot in 3C as far as constructive, but there is a very slight relative positive divergence. If you look at price making lower lows, 3C is making higher lows over here. This doesn't get me too excited, but if we look at Nvidia, which is probably the most important stock in the market, certainly the most important semiconductor, it's also having a similar price test. And you can see it here right around the 110 level. Price dipped below it a little Friday and recovered above it. So potential small W bottom. And if we look at the 3C chart, this is where it gets a little more interesting. Over here, 3C is leading price lower, but over here in this area of that, test, we can see 3C is starting to positively diverge. It's only doing so on the 1-minute time frame. That means it's a very new buying that's coming in, and we haven't seen a lot of building on that or follow through, but it is like a thread maybe that we pull on into next week, and potentially that is one of the signals that will give us an oversold rebound rally. Otherwise, the other thing that we're looking for is potentially like a larger bearish consolidation. We're right in that area where the measured move has been met, where we're at 200-day moving averages, where we're at the lower low for a broadening formation. So this is the point in time where if anything's going to happen, it should happen here and now, or in this next week. CTA's commodity trade advisors hit their medium-term sell trigger at 58.97 for the S&P 500. That opened up $40 billion of global equity supply they had to sell over this last week. The latest estimates that I've seen is that they are nearly done selling that, and that probably by the first half of next week, they will be done with their selling, their unwinding of their medium-term triggers. CTA's commodity trade advisors are trend followers, as the name suggests, largely in commodities, because commodities trend better than most anything else. But they do have a lot of global equity exposure. And when they dump all at once, like a herd stampeding. So when that ends, then we'll be back to the kind of $5 billion a day in corporate buybacks. But right now, they've been overwhelming that demand. I'm starting to see a potential big picture developing, especially with respect to the broadening formation in the S&P 500. But I do believe we need a 5 to 6% rally to get there. I'm completely open to trading that rally on the long side as a swing trade. I do want to see a little more objective evidence that we do have a low here that's tradable. But if we can get a swing trade up to like 6,000 or so, even higher, 6,100 would be fine. But to a lower high, that sets up a much larger short, much larger than this swing down, which I think would be almost like a catastrophic failure for the market. That's something I fleshed out for subscribers in the afternoon update on Friday. So if you didn't get a chance to read that, go ahead and check that out. If you're not a subscriber, consider it. I think we offer a lot of insight. I'm watching the market 12 to 15 hours a day and updating my forecast in real time. If you have not subscribed to the videos, I think now would be a great time to subscribe, because usually, I'm working so many hours, just for my clients that I don't have a lot of time to do videos. They take me often 4 or 6 hours to put together, because I don't want to waste your time. I want them to be clear, concise, move from point to point to point, not rambling. But with all the hours I work, it's hard for me to get a lot of videos out. But when I do see important things, like that video I referenced earlier, I try to get those out, because I'm on the side of the little guy here. I think the market is rigged against people who are not institutional money, and I want to do my part in helping people. That said, if you're not in a place to subscribe to the service, subscribe to my video updates, and don't forget to hit the notifications for the long form videos, also for the shorts, because I'm going to be doing more and more of those in the coming weeks and months. If you like the video, I'd appreciate a thumbs up. The more viewers I get on these videos, the more incentive I have to do them. So please feel free to share them. Share your comments too. What do you think about the market? What do you think we're looking at this year? What do you like? What do you not like? We're not just bearish the market recently. We're long stuff too. Like copper, in my opinion, looks fantastic. Copper dilly-dallied around here, consolidated in a big triangle over here. It is bullish because of the preceding trend. And then we got a breakout. If we look at this area more closely, what do we see? Advances, bull flag, advance, bull flag, breakout to a new advance. So there's a lot of stuff we're long too, and that we like on the long side. So it's not just bearish on this or bullish on that. Can be both at the same time in different assets. And I think, and what I said at the end of 2024 is, I think that 2025 is going to be a much more interesting, much more dynamic, much more volatile market. But for the average investor who's just kind of buy and hold, it's going to be very challenging. If you've got time to put on a swing trade that lasts 2 to 4 weeks, I think you can kill it this year, above and beyond returns that we saw the last couple of years. But you've got to be nimble, flexible. You've got to have at least the time to be able to run a swing trade for a couple of weeks. Check out the links to wolfonwallstreettrade.com and thetechnicaltake.net. We will be moving to thetechnicaltake.net. I still have my subscription prices set at 2008 levels. When we move to thetechnicaltake.net, I have to raise them because inflation makes it a lot more expensive for me to maintain the websites. But if you are a subscriber of Wolf on Wall Street Trade, before we move to the Technical Take, you will be grandfathered in at that 2008 rate. My way of saying thanks to long-term subscribers who've been with me for over a decade. And also, the community is going to open up in a big way at the Technical Take with our Discord room. So I'm going to get to my weekend, whatever's left of it. I hope you enjoy yours. Obviously, it's going to be a really interesting week next week. Also, follow me on Twitter. I post a lot of little nuggets there. Thanks, everyone. Thanks for listening. Please give the video a thumbs up, share it, and have a fantastic weekend.